Hey everyone, this is the fifth lesson on financial accounting. In the last lesson we covered the second level of the conceptual framework, which covered qualitative characteristics of accounting information and elements of financial statements. So in this lesson we're going to cover the third and final level of the conceptual framework. If you haven't already noticed sort of a pattern forming in the conceptual framework, each level has components of the same value as its level. So the first level has only one component. The second level has two components, so naturally the third level is going to have three different components, which are assumptions, principles, and constraints. So let's go ahead and get started with assumptions that we make when we report and analyze financial information. The first one is the economic entity assumption. Now this basically means that the business or the company keeps its activities separate from owners and managers. For example, if I own a company and I withdraw some money from that company and I use that money to buy a car, the company is not going to report that transaction on its financial statements because that's a personal transaction that I as the owner have made, and I as the owner am separate from the company, which is its own economic entity. Now it's important to note that this doesn't refer to legal entities. For example, a parent and its subsidiary are completely separate legal entities, but their activities are combined or consolidated in their annual reports because that's required by GAAP. So the second assumption is the going concern. Now this basically means that we make the assumption that the company is going to have a long life. We assume that the company is not going to go bankrupt or become insolvent, and it won't be able to pay off its debts. Now, if you are looking to become an auditor, one thing that is useful to know is that the going concern, you only need to consider it for the next year. You don't have to consider it for years afterwards. So if the going concern is inapplicable, then accounting policies might change. For example, we might want to start stating assets at fair value, and also to lessen the lives of our depreciable assets. So the third assumption that we're going to make is the monetary unit. So this assumption basically means that money is the best common denominator in terms of financial transactions. One example would be reporting $100 in revenue versus reporting one sale that we made this year. Money is really the easiest way to compare transactions, so that's what we're going to use when we're reporting financial information. We won't really report how many sales transactions we made in a year. Another thing to keep in mind is that the monetary unit doesn't really refer to any currency. This assumption will apply to all companies in all countries, regardless of whether they report their financial transactions in dollars or yen or pesos or whatever. This assumption applies to all companies. Alright, so the last assumption is periodicity. Now this assumption basically means that the company can divide its economic activities into periods. The entire life of a company can be divided into different fiscal years, which they report on their annual reports. For publicly traded companies, companies are required to issue quarterly financial statements, so fiscal years can always be broken down further into quarters. Okay, so let's go ahead and talk about the principles. Now these are principles that we use when we report financial information, and if you want to get into any type of financial statement analysis, it's very important that you know these principles. The first one is the measurement principle. So the measurement principle basically has two components, and these components are historical cost and fair value. Alright, so historical cost is basically the price we paid for an asset, or the price we incur to incur a liability. And generally it's thought to be more reliable than fair value. Historical cost gives us a verifiable benchmark. Alright, so fair value is the price that we would receive to sell an asset, or the price we would pay to transfer a liability. So basically it's the market value that we would get for an asset or a liability. So at initial acquisition of an asset, historical cost usually equals fair value. Companies have the option of using fair value when they report financial information. Now there's a trade-off between historical cost and fair value when it comes to relevance and reliability. Historical cost is much more reliable because it's based on a transaction that already happened. And fair value is thought to be more relevant because it's the price that you would get for an asset right now. And like I mentioned before with the going concern, that's really the price that you're concerned with if you want to liquidate your assets. So I want to bring in an example for this to illustrate this trade-off. Let's say that 4 years ago I purchased land for $10,000, and the fair market value of that land today is $100,000. Now on our balance sheet we're going to report that land at the historical cost of $10,000, but see, that isn't really relevant. If we want to sell the land today, we would want to know that the fair value is $100,000 to sort of know what kind of gain we could get from the sale of that land. So as you can see, there's really a trade-off between relevance and reliability. Now as far as fair value is concerned, there are 3 different levels of fair value, but I don't really think that you need to go too in depth, but I will go ahead and mention them. The first level, they go in order of most reliable to least reliable. The first level is the most reliable, obviously. These are quoted prices for identical items, so it would be probably a quoted stock price in the Wall Street Journal. That's a good example of the first level. Second level will be the fair market value of a similar asset. So in the land example that I used earlier, we would look at sales of land that are similar to the piece of land that we have in order to gain the fair market value. The third level is the least reliable, and that's pretty much the company's own assumption about an asset's fair value. Alright, so the second principle is revenue recognition. So when do we recognize revenue? Basically, GAAP dictates that we recognize revenue when it's realized or realizable and when it's earned. Alright, so what do these 3 terms really mean? Revenue is realized when products are exchanged for cash or claims to cash. So if we sell our piece of land for cash, then we've realized revenue. If we sell it for credit pretty much, and we ask that our customer pays within 30 days, then that would be a claim to cash, and we would also have realized revenue. Revenue is realizable when assets received are readily convertible to cash or claims to cash, which basically means that if we receive a piece of inventory, for example, if we can sell that inventory immediately for a stated price, then we have realizable revenue. Now, revenue is earned when the company substantially accomplishes what it must do to be entitled to benefits represented by revenues. So an example of that would be delivering a product to a customer, or if we're a construction company, it would be completing our construction project or contract. Now there are different times to recognize revenue. One would be during production, one would be at the end of production. The most common is the time of sale, and one would be upon receipt of cash. But for most companies, it's the time of sale. Usually, if you're, like, for example, if you're at the mall, you buy jeans, then the company would recognize revenue at the point they swipe your credit card or you hand them cash. That's pretty much when they recognize revenue. The third principle is expense recognition. Now, the maxim for this principle is basically let the expenses follow the revenues. So basically, whenever we recognize revenue, we also want to expense the costs that we generated in generating that revenue. And that's why this is also called the matching principle, because we're matching revenue with the expenses that we incurred. So for example, if we have raw materials and we incur labor costs and material costs in order to make that raw material into finished goods, which we put in our inventory, then we have incurred cost for that inventory item. But we're not gonna recognize that expense until we actually sell the item. And when we do sell the item, we're gonna recognize revenue from the sale, and we're gonna recognize the expense that we incurred in order to bring that item to its finished state. Now, there are basically two types of costs. There are product costs and period costs. So product costs pretty much have a direct relationship with revenue, and they are matched with revenue. They're reported whenever the revenue that they generate is reported. So some examples would be labor and materials. Now, on the other hand, period costs they have an indirect relationship with revenue, and because we can't directly match them to revenue, we generally expense them as we incur them. So one example would be salaries and administrative costs. So for example, the company's president's salary, that really doesn't have a direct relationship with the revenue that we report. So we basically expense it as we incur it. Alright, so the fourth and final principle is full disclosure. Basically, we want to provide information that's of sufficient importance to influence the judgment and decisions of an informed user. Now, there are pretty much two components to this principle. We want to disclose items that make a difference to users, but we also want to make information understandable. And this is really related to one of the constraints that we're going to talk about in just a minute. There's a trade-off here as well. But for now, it's important to know that information can be reported in one of three places. The first is the main body of the financial statements. The second is notes to financial statements. And the third is supplementary information that's included with the annual report. Alright, so now we're going to talk about constraints. These are things that we have to consider when reporting financial information. Now the first two are really what is important, but I'm also going to talk about the last two. The first one is the cost-benefit relationship. Okay, so this basically means that there is a cost associated with providing information, but there's also obviously benefits that can be derived from using information. So this time we see a trade-off again, but it's between cost and benefit. We have to weigh the cost of providing information, but we also have to consider the benefits that can be derived from using the information. So this constraint really only applies in this context to the conceptual framework. It applies to information, but we're going to see this concept really throughout all of our business practices, all of our business examples. This is something that you're going to have to take into account really at any level of the business, whether you're dealing with information, whether you're dealing with a business decision that you have to make. Alright, so the next constraint is materiality. Okay, so items that are material, they are material if they influence or change the judgment of a reasonable person. Otherwise, they're not material. So again, we want to report information that makes a difference. Otherwise, we don't really need to disclose it. And this really goes into the relative size and importance of information. So I want to bring in an example. Let's say we have two different companies. Company A and Company B. Alright, so they have sales, costs, income, and they also have unusual gains. Alright, so company A has 10 million in sales, 9 million in costs, so that comes out to 1 million in income, but it also has a $20,000 unusual gain. The second company has $100,000 in sales, $90,000 in costs, which comes out to $10,000 of income, but it has $5,000 of unusual gains. So we can see that the profit margins for both companies are the same. They're 10%, but the unusual gains relative to the income is what's important here. This is much more material than this is. So for company B, the unusual gain is 50% of its income, whereas for company A, the unusual gain is a much lower percentage of its income. So the unusual gain is going to be more material for company B than it is for company A. Alright, so the third constraint is industry practices. This basically says that some industries might use accounting policies that are a bit different than what are required for GAAP. For example, utility companies report non-current assets first on the balance sheet, as opposed to reporting them after current assets because they are a capital intensive industry. So if you might see that in practice. And the last constraint is conservatism. This is pretty simple. It basically says, when in doubt, choose the alternative that is least likely to overstate assets and income. So it's okay if we understate assets and income inadvertently, but we really want to shy away from overstating assets and income. Alright, so that was the third level of the conceptual framework. If you have any questions, you can go ahead and leave a comment. Be sure to share it with all of your classmates and friends that are also taking accounting courses if you think it'll help them out. I'm also going to be posting a little exercise for the conceptual framework just so you have it down pat before you move on. But now that we're kind of done with the theory behind accounting, we can sort of move into the practical applications of accounting. So be sure to subscribe if you want to follow, and until next time, take it easy.